Hello friends, welcome to another video of the YouTube channel Learn Finance and Accounts. In the previous video we had discussed about cost of capital from equity, and prior to that we had discussed about cost of capital through debt. So these were the two sources: cost of capital through equity and cost of capital through debt. Now in this video we are going to discuss another source of raising capital, which is preference shares. So we are also going to discuss about the cost that we have to pay, that a company has to pay for getting finance or capital through preference shares. So if you like this video, then please share and subscribe to the channel. So just to have a small recap of what was cost of capital, what is cost of capital? The cost of capital of the firm is the minimum rate of return it's expected by the investors. Capital used by the firm can be from debt, from equity, from preference share capital, and from retained earnings. So in this video, we are going to discuss about cost of capital raised through a source which is known as preference share capital. So before going to the cost, let's just discuss what are preference shares. Now in the previous video about cost of capital, we had discussed about preference shares. Just to have a recap, they are most commonly referred to as preferred stock. They are shares of the company in which dividend, which is paid to the shareholders, will be before the common stock dividends are issued. If the company enters bankruptcy, preferred stockholders are entitled to be paid from company assets before common stockholders. Most preference shares have a fixed dividend, while common stocks generally do not have a fixed dividend. So preference shares are not like equity shares because they have a fixed dividend, and there are some other features also of preference shares, which is no tax benefit and no voting rights. Dividend is fixed irrespective of profit or loss. So in case of debt, the feature was interest was fixed irrespective of profit and loss. Now in this case, dividend is fixed. Dividend, why it is called dividend? Because it is given on shares. So dividend is fixed irrespective of profit or loss, and the second feature is no tax benefit. Third feature is no voting rights. Voting rights were there in case of equity shares, but in case of preference shares, voting rights are not there. So preference shares, like debt, they also can be redeemable as well as irredeemable. We have discussed what are redeemable and irredeemable debentures. Now let us discuss what are redeemable and irredeemable preference shares. Redeemable preference shares are those which will be repaid to the suppliers. Who are the suppliers? Suppliers are investors. Investors of preference shares after a specific period. Irredeemable preference shares are not repaid to the investors, only dividend is paid. So the principal or the actual amount is not paid, only dividend is paid. So the calculation also, see, the calculation is very much similar to the calculation that we had discussed in the case of debt. So in case of preference shares which are irredeemable, KP will be calculated as preference dividend over amount received or net proceeds. See, if the time period is not known, time period of what? Time period of redemption. So they will be called irredeemable preference shares. Dividend is distributed after tax to has been paid, so there is no tax benefit. So rest of the formula is the same as that of KD. So KP is equal to preference dividend divided by amount received or net proceeds. Cost of preference shares in case of redeemable preference shares, or KP in this case, is equal to preference dividend plus redeemable value minus amount received divided by number of years for redemption, whole divided by redeemable value plus amount received divided by 2 into 100. See, there is a quite a similarity between the two, between cost of redeemable debt or cost of redeemable debentures and cost of preference shares which are redeemable. So there is quite a similarity in the formula. Now let us calculate a numerical, so which will make it quite easy for you. So the company issues 10,008% preference shares of rupees 100 each redeemable after 20 years at the face value. The flotation cost are 3 rupees per share. Remember what is flotation cost that we had discussed during the discussion of cost of debt. What is flotation cost we had discussed then. So you can refer to that video again if you want. So in this case, we have to calculate the cost of preference share capital. It is redeemable, remember. So how is it is calculated? It will be calculated as, so we are given preference dividend of 8 rupees per share. Redeemable value is 100 rupees. Flotation cost is 3 rupees per share. So the amount received will be 100 minus 3 rupees, which is 97. So what is the formula become? Formula is KP is equal to preference share plus redeemable value minus amount received divided by number of years for redemption, whole divided by redeemable value plus amount received divided by 2 into 100. So this is a formula and which is quite similar to cost of debt. So putting the values in the formula, it is 8 plus 100 minus 97 divided by 20 whole divided by 100 plus 97 divided by 2 into 100, which is 8.27%. So that's all in this video for this video. So here in this video we had calculated cost of preference share capital. Now we have calculated cost of equity, cost of debt, cost of preference share capital. So from all the three sources. So one source is left which we'll be discussing in the next video. So we will meet again. And before that, just to remind you that please see all our videos completely so that you are able to follow these. And if you want to support us so that we can continue making such educational content, then you can support us with this QR code. So we'll meet again. Thank you and bye.